Today, we're going to tackle a question that really separates the legendary investors from, well, everyone else. How do they find a company's true value, especially when the market seems to be screaming the exact opposite? I'll give you a hint. It isn't magic. It's a method, and we are about to break it all down.
Have you ever wondered about this? You see a stock that looks just crazy expensive, but you hear that some of the pros are quietly buying it up. Or maybe the reverse. A stock looks like a total bargain, but all the smart money is staying miles away. What on earth do they see that we don't?
Well, the secret isn't some mystical gut feeling. It's actually a super logical way of looking past all the noise, all the headlines, and focusing on the one thing that matters, the fundamental economic engine of a business. So let's pull back the curtain and see exactly how it's done.
Okay, so let's start with the big problem, the thing that trips up so many people when they're getting started. I like to call it the stock value puzzle. This is the million-dollar question, isn't it? That price you see flashing on your screen, that's just what somebody was willing to pay for it a second ago. But is that its actual, intrinsic worth? How can you possibly tell if you're getting a great deal or just paying way too much?
Now, most people start with the simple stuff, like the PE ratio. But here's the catch, and this is so important. The PE ratio tells you nothing about a company's future growth. For a modern tech company with few physical assets, the price-to-book ratio is pretty much useless. And dividend yield? It can't tell you about all the cash being poured back into the business to fuel massive growth. Using these metrics is like watching a single frame of a movie. You totally miss the entire plot.
So if those simple tools are kind of broken, what's the answer? Well, for that, we can turn to the legends, guys like Warren Buffett, and their go-to method, DCF.
And this quote right here, this is the whole philosophy in a nutshell. What Buffett's saying is, forget the daily market chatter, forget what the analysts are saying. A business is, at its core, a machine that's designed to generate cash over time. So if you want to know what it's worth today, you have to figure out all the cash it's going to produce in the future and then calculate what all that future cash is worth in today's money.
And that is exactly what discounted cash flow, or DCF analysis, does. Honestly, the best way to think about it is like a financial time machine. It lets you zip into a company's future, gather up all the cash it's expected to spit out, and then bring it all back to the present day to see what it's really worth.
Now, check this out, because this is where it gets really surprising. You'd think valuation is all about what happens next year or the year after. But look at this. A huge chunk, we're talking 60 to 80% of a company's value comes from something called its terminal value. That's the value of all of its cash flows beyond our initial forecast, way out in the future. It's incredible, right? It just shows you that DCF forces you to think like a true long-term business owner.
Okay, so it sounds pretty powerful, but how does it actually work? Let's pop the hood and look at the engine of a DCF analysis. It might seem a little complex at first, but I promise you the logic behind it is actually beautiful and simple.
It's basically a 5-step story. First, you project how much revenue the company is going to make. You're asking, how big can this thing get? Then you estimate how much of that turns into free cash flow. That's the real cash left over for the owners after everything's been paid. Third, you calculate that big terminal value for everything way down the road. But hang on, money in the future is worth less than money in your pocket today, right? So you use a discount rate to bring it all back to today's value. And finally, you just add it all up to find the company's true intrinsic value. See? It's a journey from future potential to present-day price.
Theory is great and all, but let's make this real. Let's see how this whole process can uncover hidden gems in the real world. We're going to look at a case study of a company called Asian Paints from back in March 2023.
So here's the situation. On the surface, Asian Paints looked pricey. A price-to-earnings ratio of 45 is pretty steep by almost any measure. For anyone just looking at those simple metrics, this stock was a hard pass. It was screaming overvalued.
But the analysts who did a full DCF analysis saw a completely different picture. They built a model using these kinds of assumptions: really solid revenue growth, strong profit margins because of the company's size, a pretty conservative guess for long-term growth, and a discount rate. That's the WACC you see there, which is just a number that represents the company's risk. Now, these aren't wild stabs in the dark. They are educated guesses based on the company's real-world position. And what was the result of all that work? Well, the DCF model spit out a potential upside of a whopping 44%. It was basically saying that the market was completely misjudging the long-term cash-generating power of this business. The simple PE ratio was telling one story, but the deep-dive DCF was telling a much more optimistic one.
I mean, this visual just says it all, doesn't it?
The market was pricing the stock down here, around 2,850 rupees. But the fundamental analysis, the deep dive into its future cash, suggested its true value was way up here, closer to 4,100. That gap right there, that's where smart investors find their opportunities. And by the way, the stock did eventually cross that 4,100 mark, which pretty much proved the analysis was spot on.
This case study just perfectly highlights the fundamental choice that every single investor has to make. Are you going to operate in the world of guessing, or are you going to step into the world of knowing?
On one side of the coin, you have guessing. That means relying on simple stuff like PE ratios or just blindly following what some analyst says without really understanding why. But on the other side, you have knowing. This is doing the actual work to understand how good a company is at generating cash, not just for next quarter, but for the long term. It's a huge shift from being a speculator to being a true business analyst.
And really, that's the big question I want to leave you with. When you look at your own process, are you just reacting to the market's mood in simple numbers, or are you digging deeper to understand the real, durable value of the businesses you're putting your money into? The answer to that one question could honestly make all the difference.